Hello everyone, I'm Gian Cruzia Yulo. For today's video report, we'll be exploring risk and rates of return. CAPM theory stands for Capital Asset Pricing Model. It describes the relationship between expected return and risk of an investment. Under this theory, beta is the most appropriate measure of the systematic risk and volatility relative to the market. Investor activity drives expected returns to match required returns, with temporary diversion possible until equilibrium is reached. When considering buying a stock, a person can't know the actual return it will generate. The risk-free rate is typically based on U.S. Treasury securities. It can be measured using short-term T-bills and long-term T-bonds, most common due to matching investor holding periods. A stock's rate premium varies based on its beta. It is lower if beta is below 1.0, equal if beta is 1.0, and higher if beta exceeds 1.0, with the average stocks premium serving as the benchmark. It is the additional return investors expect to earn from investing in the stock market above the risk-free rate. It is reflects the market's overall risk profile and investor sentiment, influencing the returns investors expect from investing in the stock market. Estimating the risk premium of an average stock is challenging due to uncertainty surrounding future market returns. To address this, analysis often rely on historical data. However, this approach has limitations as past data may not accurately reflect current market conditions. Furthermore, some evidence suggests that the market risk premium has decreased in recent years. Nonetheless, individual stock risk premiums can be systematically estimated by considering their beta coefficients, which measure their volatility relative to the overall market. The equation shown uses the security market line equation. It is an equation that shows the relationship between risk as measured by beta and the required rates of return on individual securities. The security market line graphically illustrates the relationship between risk and required returns for stocks, with risky securities having a beta of 0 and returns equal to the risk-free rate. The SML slope reflects the market's risk aversion, with slippery slopes indicating greater risk aversion and higher required returns. Investment earning returns above or below the SML have positive or negative alpha. respectively, helping investors evaluate performance relative to market expectations. It helps the investors and managers understand the relationship between risk and potential returns. At its core, the CAMP rely on the market risk premium, which is the difference between the expected return on the stock market and the free risk rate. Essentially, it is the extra return investor demand for taking on the risk of the stock market. Both the SML and the company's position on its change over time due to changes in interest rates, investor risk aversion, and individual companies' betas. Notice that the increase in RR leads to unequal increase in the rates of return on all risky assets because the same inflation premium is bullet into required rates of return on both average stock RR, both riskless and riskless assets. Therefore, the rate of return in our illustrative average stock RA increased from 8% to 10%. Other risky securities returns also raised by 2 percentage points. Trivials investors' risk tolerance with slippery slope indicating greater squeezation and higher return expectations. For riskers investments in a risk natural scenario, the SML would be flat, but due to investors' aversion to risk, the line slope upward, reflecting the added return required for taking on risk. Figure 8.10 demonstrated the impact of increased risk aversion on the market. As investors become more equation, the market risk premium raised from 5% to 7.5%, causing the required return on the market to increase from 8% to 10.5%. This shift in risk aversion has a more pronounced effect on riskier security with higher beta stock experiencing larger increase in required returns. Companies' beta market risk can change due to internal factors. Example, asset mix, debit levels, or external factor. Example, competition regulations. When beta changes, the company's required rate of return has changes affecting its stock price. Increases in beta have a negative effect on the firm's stock price. Researchers are developing alternative models to the traditional CMP, incorporating multiple variables beyond just a beta. These multivariable models recognize that market risk is influenced by various factors, not just market returns. Although these models offer a more nuanced understanding of risk, they have limitations when applied in practice. Despite this, they represent a significant advancement in finance theory. The traditional CMP remains the most widely used method for estimating required returns on stocks. Corporate managers and investors need to understand the relationship between risk and return. Managers evaluate project risk based on its impact on the company's overall stock risk. A project's standalone risk may be high, but if it is offset other risks, overall risk decrease. This concept also applies to diversity investors who consider how investment affect their portfolio risk. Investors should understand that there are trade-off between risk and return, meaning higher risk investments should be offer higher expected return. Diversification is crucial to reduce risk without sacrificing returns, and investors should avoid putting all their money in one stock or industry. When evaluating investments, it's essential to consider real return which account for inflation rather than just nominal returns. This risk of an investment also depends on the holding period, with stocks being riskier in the short term but less risky over the long term. Finally, past performance is not a generate for future results, so investors should be cautious and consider valuation when making investment decisions. That's all for today's video. Stay tuned for more insight.